This is a presentation on operational budgeting, and you'll find that the budgeting process is fairly mechanical. So we're going to go through the detailed mechanics of how an operating budget is constructed. Okay, let's talk about the overall budgeting process. And typically the overall budget that accompanies the operating budget and the financial budget is called the master budget. And if we take a look at this from the 10,000 foot view level, again, we have two portions. We have an operating budget and the financial budget. 90% of what we're going to be covering, or even a higher percentage of that, will be on the operating budget, since most questions on the CPA exam center on the operating budget. Now, the budget starts off with sales projections. And when you think about it, it's difficult to, if a business is in business to make money, that's through sales. So everything literally, the entire justification for all budget items has to come as a result of the company selling something. So the first thing we're going to do is we're going to come up with what we call unit sales projections, and what and how much product are we going to sell, and when are we going to sell that product, in April, May, June, or does it happen in December, or ratably throughout the entire year? This is a question that has to be determined in the unit sales projection. Again, remember, I'm saying units. I'm not even talking about dollar amounts at this point. After that, then, after we know how many units we're going to sell and when, we have to come up with the production budget. Is basically what and how much product are we going to produce, and when are we going to produce it. Next, we're going to come up with the selling expense budget and the administrative expense budgets. Okay, now the sales budget, basically, if we break that down a little bit more, it's basically also, not only are the units, basically what are the units we're going to sell, but at what price will the products be sold. And we want to also come up with the total sales by product by period. And the question is, what inventory levels do we want to maintain to make sure we don't run out of stock or miss lost sales opportunities? After that, then, we have to develop the production budget to basically service that sales budget. And in the production budget, there's three major components. And again, it follows our product costs: direct materials, the quantity, price, and timing of direct material purchases; direct labor, the quantity, price, and timing of applying direct labor; and overhead, the quantity, price, and the timing of overhead. We also then have a selling expense budget, and typically our selling expense budget will be composed of at least variable cost and fixed cost. Also, our administrative expense budget will be composed of variable costs and fixed costs. From that, we then develop all these budgets. And some budgets we develop cash flow goals and projections, and from that comes out four major budgeted components: the budgeted cash flows, the budgeted balance sheet, the budgeted income statement, and the capital budget. Now that's financial budget. That's in addition to all these other budgets under the operating budget. Okay, question number one. And question number one is a learning slide. And again, if you don't know the answer, come up with what you think the answer is, and we'll learn a little bit about some budgeting terms. Zyxx Corporation has developed a budget based upon the proven need for every expenditure without regard to the previous budget. So what they're saying is we start the budget from new every year. This form of budgeting is best described as and you are given your 4 different answers. Go ahead and make your choice. You may know the answer. If not, come up with what you think from the description is the most logical answer. After that, then, of course, stop your video, and then when you're ready to review your answer, go ahead and start your video. Okay, number 1, basically the form of budgeting of basically starting out from without regard to the previous year's budget and just creating a brand new budget every year is what we call B, zero-based budgeting. As I describe it here, zero-based budgeting can be described as a method that examines each budget item line and requires the justification of the expenditure without any reference to the prior year's budget. So it identifies the tasks within the responsibility center and the resources required to accomplish those tasks. So that's why we call it zero-based budgeting. It starts anew every year. Kaizen budgeting is creating budgets that strive for continual improvement. In other words, this was good enough this year, but now we've met that budget. Let's go ahead and try to beat it next year, and so on and so on. Flexible budgeting is budgeting based upon volume levels. In other words, if I produce 10,000 items, what is my budget going to be based upon those 10,000 items versus if I produced 5,000 items? A rolling budget is where annual or quarterly budgets are maintained by taking on an additional month or a quarter, or basically taping that on to the additional month or quarter to the current budget as the year progresses, and that's why we call that a rolling budget. Number 2, again, this is a learning slide. Department A creates a budget that will always ultimately result in favorable variances. In other words, we're always going to end up spending less than was called for in the budget. This is known as, and you're given 4 different choices. Stop your video. When you're ready, restart your video and we can review the answer. Okay, Department A creates a budget that will always ultimately result in favorable variance. This is known as C, budget slack. Setting a budget with the easily obtainable revenue and cost goals will normally result in a positive budget variance, a favorable budget variance, and we call this budget slack. Now, this is where you also have to be careful with the way examiners may ask questions, as I say here. For example, the phrase budget stacking sounds a lot like budget slack. Plus it presents it first, and students tend to look at the answer, and when they see what they think is the answer right away, they go ahead and select it without reading all the potential answers. So if you're not reading the question carefully, you may decide that budget stacking is a correct term and gloss over the remainder of the answer. So again, this is a learning slide in terms of budget terms, and also, again, understanding that the examiners will ask questions with an attempt to potentially confuse you. Number 3, the master budget we got from our original slide. The master budget includes, again, you're given 4 choices. Go ahead and make your choice and stop, and also stop the video. And when you're ready, go ahead and restart your video. Okay, the answer to number 3 is the master budget is B, includes the operating budget. And if we take a look at the diagram, and this was a presentation from our first slide, the master budget normally includes the operating budget and the financial budget. The master budget includes all budget items and is a master document for our planning purposes. Also, we have to understand that the master budget is, again, for planning. It does not normally include actual costs. Number 4, which of the following is included in a company's financial budget? If you remember that first PowerPoint slide, all those items located over on the far right, and you're given 4 choices. Yeah, so which of the following items is included in the company's budget? So go ahead, stop the video, arrive at your answer, and when you're ready, go ahead and restart your video. Number 4, which of the following is included in the company's financial budget? And the answer is B, cash flows. In effect, the cash flow budget. And you can see again in the diagram that I presented in the first slide, you can see where the financial budget does include budgeted cash flows. Okay, number 5. The operating budget would not include, again, you have 4 choices. Stop the video, make your choice, and when you're ready, restart your video. The answer to number 5, the operating budget would not include C, capital expenditures. That's because that is included, as you can see in the diagram, in the financial budget. Okay, number 6, which budget must normally be completed first? So stop your video, and when you're ready, restart your video and review the answer slide. Okay, number 6, which budget must normally be completed? Now we're going to go over the mechanics of creating an operating budget from our master budget. So the first thing we have to start off with, again, is our sales. So XYZ Corporation prepared the following unit sales forecast for the next quarter plus 1 additional month, because that's going to be needed in our computations. The company sells its products for $300 a unit. So let's take a look at the quarterly sales budget here in terms of sales in units, not in dollars amount, but in dollar amounts, but in units at this point. So April 500, May 580, June 540, July 620. Now we know the company sells its product for $300 each. So we take the April unit sales times the selling price of $300, and it comes out to total sales for the month of $150,000. So those are our budgeted sales. We're going to do the same thing for May and June. We're going to multiply the units times the sales price and come up with the dollar sales. After the sales budget, we then need to prepare a production budget that supports the sales and management's plans for inventory levels. So again, from the previous slide, we take a look at our unit sales for the quarter, April through June. Now, we also know, and this is given to us, the company wants to end each month with ending finished goods inventory equal to 25% of its next month's sales. Ending inventory for the month of March is 125 units. Now, the reason we want to have inventory left over is that we want to have a cushion for sales variability. If we don't have inventory to supply to somebody who wants to buy something, that sale is lost. So we want to make sure our ability to maintain our customer sales and service is not interrupted. So in this case, the company says we want to have our inventory at the end of the month equal to 25% of next month's sales. So I took a look at my quarterly production budget again, and that's from my current month's budgeted unit sales. That's what I start out with. Also, my July sales are going to be 620 units. Now, what I do is I take the ratio of my inventory to future sales. And what that is I take my future sales, my future month of 580 units, I multiply it times 25%, which represents the cushion that I need for the next month's worth of sales. That means my ending inventory at the end of April should be 145 units to accommodate the 580 units of sales in the following month. I'm going to do exactly the same thing for May and June, where I take the June sales of 540, multiply it times 25%, I end up with 135 budgeted ending units to service June's sales. And the same thing then for June based upon the July budgeted unit sales projections. Now, the budgeted unit sales for the month are 500. The required units then to meet production are equal to my budgeted ending inventory units, we're doing April right now, of 145 units, plus I know I'm going to have 500 units to accommodate the sales for the month of April. So the required units that are going to be necessary in order to meet production for the month are 645. That includes my sales and my desired 25% cushion of the next month's sales. Now from that though, I have to subtract what I already have in inventory. So I subtract out my budgeted beginning inventory, which is 125 because I've already produced those. So the units required to meet production of 645 minus what I've started off with means that I have to produce during the month 520 units in order to not only meet my sales, but also to make sure I have 25% of the next month's sales on hand at the end of the month. Let's take a look then for May and June. You can see similar computations for May and June. Okay, now let's take a look at question number 7. Hefeweizen Brewing Company had the following budget data. The total units it produced was 200,000. Units that are in beginning inventory is 20,000. Units that are planned to be in inventory is 30,000. So if that's the case, if we know how many we produced, how many we started out with, and how many we want to end up with, it says based upon the above budget data, how many Hefeweizen units are included, would be included in the sales budget. And again, we're given our 4 answers. Stop the video. When you're ready, restart the video and review the answer slide. Number 7, it's a matter if it's an inventory computation. The answer, by the way, for number 7 is D, 190,000 units. So we compute the inventory movement, and it's a classical inventory formula. We start out with our beginning inventory of 20,000 units. To that, then, we add our scheduled production, which is 200,000. Okay, what we don't know is how many units that we sold. That's the question we're going to have to answer, but in the end, that equals 30,000 units. So it's a matter of some very simple algebra, in effect solving for X, or the question mark. And the answer in this case has to be 190,000 units. In our previous slides, we created the unit production budget for the quarter. Now we need to create the budget to support that production. So you can see the quarterly production budget in units from the previous slide at the top of our slide here, April 520 through May and through June then. And we also need to know some information about in this case, we're going to be acquiring direct materials to build a unit. So we need to know about our management requirements for direct materials. We know the beginning inventory for April direct materials was 780 pounds. So that's the amount of inventory we're starting out with. We also know that our July production material requirements are 600 units. That's outside of the quarter, but we'll need that for part of our computation. Assume each finished unit requires 5 pounds of direct materials, and the company wants to end each month with raw materials inventory equal to 30% of the following month's raw material production needs. So in effect, we want to have a cushion in order to accommodate our production from month to month. Raw material costs are expected to increase by 50 cents a pound, and that will happen in May. So now we're going to calculate our direct materials production budget. We take a look at April. We know our budgeted production in units is 520 units. We also know it requires 5 pounds of materials to make 1 unit. So we multiply 520 units times the 5 pounds of materials, and what we need then is 2,600 pounds of material that is required to produce that month of production. We also do that same calculation then for May and June, where we can see the amount of pounds that are going to be required in each month. Okay, now in order to do our inventory calculations, we have to come up with the budgeted ending inventory, and that is going to be equal to 30% of the following month's material production needs. So in this case, it's 2,850 pounds in May. We multiply that times 30%. So what we're saying is we need to end the month of April with 855 pounds of materials. So the total material requirements that we have then are going to be the 2,600 pounds needed for production plus the amount of inventory that we're going to need to have on hand at the end of April, 855 pounds. So our total material requirements for the month of April will be 3,455 pounds. Now we know that we already have 780 pounds in our beginning inventory for April, so we don't have to produce or we don't have to buy that. So we take 3,455 pounds, again our material requirements, we subtract out the beginning inventory of 780 pounds, so the materials to be purchased in pounds is 2,675 pounds. We multiply that times our material cost of $9 a pound, and I know I didn't mention that in the narrative. It would normally be there, so I apologize for that. So just assume that the narrative did tell us our cost per pound would be $9. So we take the $9 per pound times 2,675 pounds, and the total cost of materials to be purchased for the month would be $24,075. We're going to do the same process for May and June. However, the one difference that is going to occur is we're told that in May, our material costs are going to go from $9 a pound, are going to increase by 50 cents a pound. So that goes from $9 per pound to $9.50. So we take our material purchases in May, and instead of multiplying it times $9 a pound, we multiply it times $9.50. So the cost of materials to be purchased in May are $26,933. And then we repeat that computation, including the $9.50 cost per pound for June. Now, question number 8. The Box Brands Company plans to sell 120,000 containers, and they're going to sell that evenly per month, 10,000 a month, in other words, in the upcoming year. The company has 10,000 containers on hand at the beginning of the year. The company plans to maintain a level of containers that would be equal to 10% of monthly sales at the end of the year. The production budget in units for the year is, and we're given 4 choices. Stop your video, and when you're ready, restart the video to review your answer. Okay, the answer to number 8, the production budget in units, or containers if you will, for the year is D, 111,000. So let's go through the explanation on this problem. Number 1, if I know I have sales requirements for 120,000 units, I know I'm going to have at least 120,000 units to sell. Number 2 is I know I'm starting out with 10,000 containers. Therefore, I'm only going to have to produce 110,000 containers to meet my 120,000 annual container sales budget. However, I also need to have some number of containers left in my ending inventory per my narrative at the top. I want to have 10% of my monthly sales in ending inventory. So I need to compute the number of containers that need to be included in ending inventory at the end of the year. So I need to come up with my monthly container sales, which is 120,000 annual container sales. And as I said, they're sold evenly per month, so I divide it by 12 months. So my monthly container sales are equal to 10,000 per month. Now, the number of containers that I need in my ending inventory is equal to, in effect, if I said 10,000 containers in monthly sales times the 10% cushion, that means I'm going to have a cushion or an ending inventory at the end of the year of 1,000 containers. Therefore, number 4, I will need to add 1,000 containers to my planned production to ensure I have 1,000 containers left at the end of the year. So I know I'm going to have to produce 110,000 containers plus 1,000 containers to be left in inventory. So that means I'm going to need to produce 111,000 containers. Okay, question number 9. Each box brand container produced requires 4 units of product A. The company uses a flexible budget to set budgeted production costs. A review of the company's flexible budget indicates the budgeted amount for the purchase of product A is $1.50 per unit. Now, let's assume the company has 30,000 units of product A in beginning inventory and wishes to have 10,000 units of product A in their ending inventory. So we want to compute the company's budgeted purchase cost for product A at a production level of 100,000 containers. And you're given the For potential answers, stop your video. When you do your computation, you're ready for your answer slide, go ahead and restart your video. Okay, now let's go on to the production budget that will support a production budget for direct labor that will support the unit production within the quarter. Again, we take our quarterly production budget that we've created several slides ago for April, May, and June. And in the narrative, according to our production records, or if you will, it could even be our standard cost records or bills of materials, or routers, and so forth. According to our production records, it takes 2 hours of direct labor to make 1 unit. The cost of direct labor is $30 an hour. Now, we have to come up with a direct labor production budget. So we take our budgeted production of 520 units. The hours required to produce 1 unit is 2 hours. Therefore, the direct labor hours needed for production will be 1,040 hours during the month of April. We multiply that times $30 per hour, so the direct cost required for production for the month would be $31,200 for 1,040 hours of direct labor. We also repeat that same calculation for May and June. Now we need to calculate the overhead costs that are also going to be necessary to support our production efforts. And again, we see our production budget with units to be produced for April, May, and June. Again, according to our production records, variable overhead costs are incurred at $25 a unit. Fixed overhead costs amount to $50,000 in April and May and are expected to increase by 10% in June. So now we can do our calculations. Okay, our overhead production budget in April, we take our budgeted production of 520 units times our variable overhead cost of $25 a unit. That means the total variable overhead cost to be incurred for production is going to be $13,000. To that then we add our fixed overhead cost for the month, which is $50,000, and it doesn't matter what volume we're talking about because it is still fixed relative to volume. So the total overhead cost to be incurred for production in April is $63,000. We do the same process in May and June, except in June, we have to anticipate a 10% increase, so our fixed costs go from $50,000 up to $55,000. So now we have our overhead production budget for June. Now we're going to prepare our selling expense budget. And in this case, again, we can see our quarterly sales budget in units and also in dollar amounts. Okay, so sales commissions are paid at 2% of gross sales, and fixed expenses amount to 8% or $8,000 per month. So when we say sales commissions are 2% of gross sales, that's the same thing as variable cost. So in this case, again, in doing our calculations, we take our period cost and selling expenses for April. We know our sales are going to be $150,000 a month times our variable sales commission at 2%. So we have variable sales commissions expenses of $3,000. To that, we add on to our fixed sales expense, and those don't change no matter what our volume is. So the total selling expense for April will be $11,000. We repeat this process for May and June, and the only items that, well, the items that change are obviously our sales based upon our sales unit change, plus our sales commission. You can see the amounts are different for May and June. Okay, question number 10. A portion of the variance between budgeted production cost in a static production budget and actual production cost incurred will be due to, and you're given your choices. And when you're, go ahead, stop your video. When you're ready, restart your video. Okay, number 10, a portion of the variance between budgeted production cost in a static budget and actual production cost will be due to, and the answer is C, changes in direct materials, direct labor, and variable factory overhead due to changes in production volume. When we refer to the term static or static budget, what that means, it's a budget that was created at a specific volume. Therefore, at other volumes, that budget may not be entirely accurate. And the reason for that is because we have variable costs. So in this case, we can basically look at C, and that's the correct answer. And that's a production budget. A production budget would include our materials, labor, and variable overhead. Changes in the production volume would produce variances from the static budget. If we take a look at A, changes in all fixed costs due to changes in the production volume. A, the problem asks about budgeted and actual production cost, which will automatically exclude A, as it refers to all fixed costs, and we're only talking about production cost. Also, it's important to note that the fixed costs are fixed because they do not change with changes in volume. Okay, we take a look at the B where it says changes in all variable costs due to changes in production volume. That's kind of true, but it has the same problem as A since it refers to all variable costs, not just all variable production costs. So there may be non-production variable costs. And then D, changes in fixed factory overhead costs due to changes in production volume. Again, by definition, fixed costs do not change with changes in production volume, so there'd be no variance produced between the static budget, which was fixed cost, and the actual fixed cost, because they would remain the same. Okay. Now we need to prepare an administrative expense budget. And our fixed administrative expenses amount to $15,000 a month. There will be a one-time payment for taxes of $40,000 in June. So we take a look at the period costs that we build up here, monthly administrative expenses. We see the $15,000 a month, but then in June that jumps up to $55,000 because we're going to include a tax payment. Now what we want to do is, based upon all the information that we've garnered from all of our previous slides, we want to prepare a cash inflow budget. So for sales, the company collects sales in the following manner. 30% of our current month sales are cash sales collected in the current month. So that's money coming right in when we sell the product. 70% of the current month sales are collected in the following month. So most of our sales, on the majority, 70% of our sales are in receivables. The March sales, which we're going to need in our computations, were $140,000. So let's prepare a cash inflow budget. Okay, our total sales for the month of April, as we got from our sales budget, were $150,000. The cash collection for our sales in the current month, as we mentioned, would be 30% of our total sales. So we know we're going to collect $45,000 in cash in the current month from our sales. But we also have to factor in the fact that 70% of our previous month's sales, and that would be the 140,000 sales in March, were also collected in April. So to that we have to add $98,000, which is 70% of the 140,000, to arrive at our total cash inflows for April of $143,000. We repeat that process for May, and we repeat it again for June. So we see that we have a series of cash inflows, and they differ based upon our sales and our collections. Okay, question number 11. Five Seasons Clothing commenced operations in January of the current year and has the following sales data. And you see the sales data for the first 5 months of the year. 10% of the sales are in cash, 70% of the sales in 1 month are collected during the following month, and then 20% of the sales are collected 2 months after the month of the sale. So the question here is, what is the budgeted cash inflow from sales for the first quarter ending in March? Okay, number 11, the answer. What is a budgeted cash inflow from sales for the first quarter ending in March? And the answer in this case is C, $119,000. So here's how we develop the calculation. The problem is simplified in that we started our operations at the beginning of the current year, so we don't have to worry about prior month cash collections. So starting off with January, we collected 10% of the sales, and our January sales were 100,000, so 10% of those sales were $10,000. In February, then, we collected 70% of January's sales, so we collected $70,000. And then in March, we collected the remaining 20% of January's sales, so that amounts to $20,000. In February, we had $120,000 worth of sales, so therefore we collected 10% in the month of February. We then collected 70% in the month following, and that would be $84,000 for February. Now we look at our March sales. And our March sales, again, we collected 10% of our March sales, which are $150,000. So we collected $15,000 of our March sales in March. So we add up our total cash inflow from January, February, and March, and it totals the $119,000. Now let's prepare a cash flow budget, and we're going to have to do this in different parts. We're going to start out with product costs. So our cash flow budget is going to work with start with product costs. Okay, number one, we're given this information. The company pays for 50% of its direct materials purchased in the current month. Then it pays the other 50% in the following month. So what we have to do is we basically pay 50% in the current month, and then we have the other 50% as an accounts payable for the following month. So the cost of direct materials to be purchased, and this is from our cost of materials budget that we calculated earlier, was $22,203. So the cash that we're going to pay for our purchases in the current month is going to be 50%. So out of our total purchases of production materials, we're going to pay in cash $11,102. Okay, cash paid for direct materials purchased from the previous month. So remember, we did have to purchase from the previous month, and we know the amount was going to be, we have here cost of materials purchased in the March were $22,200. So 50% of that is $11,100. So the cash outflows for the purchases of direct materials for the month of April are $22,202. Going to do the same calculation for May. The cost of materials to be purchased from our materials purchase schedule, production schedule, is $26,933. And then we're going to pay cash for 50% of those purchases, plus we're going to pay cash the remaining cash from the purchases from the month of April. And we total that together, and our cash outflows for the purchase of direct materials is $24,568. And we're going to perform the same calculation in June. Now we're going to do, instead of direct material cost, now we're going to do direct labor cost outflows. And payroll costs are paid in the month that they're incurred. So if we take a look at the direct labor costs required for production, and again, this comes from our direct labor production schedule, that amounts to $31,200 for April. So the cash that we're paying, we say we pay all of that within the month that they're incurred. So the cash paid for our direct labor payroll in April is the $31,200. So the cash outflow for direct payroll is $31,200. Okay, the same thing in May. We get our direct labor costs required for production from our production schedule, $34,200. The cash paid for our direct labor is $34,200, so the cash outflow is $34,200. We perform the same calculation for June. Now we take on the overhead cost outflows. Now, overhead costs are paid in the month following when they are incurred. And we also are told that overhead costs for the month of March were $58,000 because we're going to need that in the calculation. So now our total overhead cost to be incurred for production was $63,000, and that's from our production schedules. So that's $63,000, but that's not the amount we paid because we don't pay that until the following month, in other words, May. But we did pay for the overhead costs that we said we incurred in March for $58,000. So the cash paid for overhead cost was $58,000. We go to May, and the total overhead cost to be incurred for production is $64,250, but that will not be paid out in cash until June. So in this case, we take the amount that's paid out in cash is $63,000, which was the amount that we incurred in April. And we're going to do the same process in June, where we're going to pay for a total cash paid in overhead cost will be $64,250. Now we're going to do a summary of our production cost outflows. So the cash outflows for the purchase of direct materials in April were $22,002, and that's from the top schedule on this slide. The cash outflows for the direct labor for payroll, which is the second schedule on the slide, comes out to $31,200. And lastly, the cash outflow for overhead cost, which is the third schedule on the slide, comes out to $58,000. So the total cash outflow for our production costs for the month of April are $111,402. We'll do the same thing for May. Again, right from the schedules, and the total's $120,768. And then in June, exactly the same thing. We'll repeat from the upper schedules, and the total outflow for production costs is $122,474. So now we have a cash flow budget for per product costs. Okay, let's try question number 12. A company is creating a budget for its cash disbursement for inventory with the following information. We have $3 million in sales. We don't know what accounts payable is, but we know we had an increase in accounts payable of $250,000. We also don't know inventory, but we know we had a decrease in inventory of $100,000, and we have a gross margin of 20%. So the question is, what are the estimated cash disbursements to fund inventory? You have 4 answers, and I will tell you this is not an easy question. It requires your understanding of the relationship of your inventory accounts, accounts payable, costs of goods sold, and your cash accounts. So this may take you a while. Again, stop the video when you're ready with your answer, restart your video, and then go over the process because it's pretty important to understand this one. Let's take a look at the answer to number 12. Again, the question is, what are the estimated cash disbursements to fund inventory? And the answer in this case is C, $2,050,000. In order to solve this problem, and again, it's not an easy problem, you have to understand the relationships between accounts payable and cash, between inventory and accounts payable, and between cost of goods sold and inventory. So let's see how those relationships are depicted here in this solution. First thing is that we know that if inventory decreases, the general reason for a decrease in inventory is because we sold the inventory. It's been moved out of inventory and then it gets debited to cost of goods sold. So you have a debit to cost of goods sold and a credit to inventory. We also know that if inventory increases, a debit to inventory, that was caused by the purchase of inventory, and that would come through an increase in our accounts payable because we typically buy inventory on credit. So in this case, it would be a debit to inventory and a credit to accounts payable. Lastly, if we have a debit to accounts payable, the likely place that came from was a credit to cash where we pay down the accounts payable. So this represents a debit to accounts payable and a credit to cash, which was used to pay down accounts payable. Now we're going to take that concept and add a concept also called gross margin, and we're going to go back and see how we determined the cash disbursements of $2,050,000. So again, let's take a look at our accounts: cost of goods sold, inventory, accounts payable, and cash. Okay, the first thing we have to determine is that cost of goods sold is some amount. So what amount is this? The answer to that is, and I call this entry A, cost of goods sold is computed as, we know we have $3 million in sales as part of the problem. We also know we have a gross margin of 20%. So that means that basically the amount of cost of goods sold, because our sales minus our cost of goods sold equals our gross margin. So our cost of goods sold should have been 80%, or 1 minus 0.20 gross margin. So that means at 80% times 3 million, our cost of goods sold must have been $2,400,000. Okay, now let's determine where that $2,400,000 came from as a debit to cost of goods sold. Well, what we said in terms of relationship, that amount must have been moved from our inventory account. So, and moving from the inventory account is a credit to inventory of $2,400,000 and a debit to cost of goods sold of $2,400,000. So we have the credit entry to inventory now. Next, we have an inventory amount where we show that we take a look at our inventory amount, and we had a decrease in inventory of $100,000. So if our inventory decreased by $100,000, that must mean is we had enough debits to equal $2,300,000, because if we have debits of $2,300,000 and credits of $2,400,000, that would indicate there would be a decrease in inventory of $100,000. So if we have a debit to inventory of $2,300,000, that must have come through an increase in inventory that was financed through accounts payable. So our debit to inventory is $2,300,000, and our credit is to accounts payable for $2,300,000. Now you'll also notice our accounts payable increased by $250,000. So in this case, right now our accounts payables increased by $2,300,000. So there must have been an offsetting debit that is $250,000 less. So in that case, it would be a debit of $2,050,000, and then that debit, typically reduction of accounts payable, come from a disbursement of cash. So we see then a debit of $2,050,000 versus a credit of $2,300,000, and we have our increase in accounts payable of $250,000. And we can see then we've derived our cash disbursement for the payment of inventory of $2,050,000. Okay, with that, let's go on to the final schedules. And this is preparing our cash flow budget for selling and administrative expenses. And selling and administrative expenses are paid in the month that they're incurred. So we have here again for April, May, and June our selling expenses and our administrative expenses. So our total period costs are calculated for April, May, and June. Now, in terms of preparing our cash flow budget, the company had an ending cash balance of $1,000 in March. So that's what was in their checking account. So looking at the quarterly cash flow budget, again, getting this from our previous cash inflow schedules for sales, we had cash inflows in April of $143,000, May $157,000, and we anticipate $170,400 for June. Our cash outflows due to production cost are April, May, and June. These represent the cash outflows. Cash outflows from our period costs then are the April, May, and June period costs. So we have total cash outflows equal to, in April, $137,202, May, $148,247, and in June, $188,714. Now we have to reconcile our cash balance. Our net change in cash in April is we had a increase in cash of $5,798. In May, we had an increase in cash over and above April of $8,953, and in June, we had a net decrease in cash of $18,314. So if we start off with our beginning cash balance beginning in April, we take our net change in cash in April of $5,798. To that, we add to our existing cash balance $6,798. So now that ending cash balance in April becomes our beginning cash balance of $6,798 in May. Our net change in cash was a positive inflow of $8,953. We add that to our beginning cash balance. That means that our ending cash balance for the end of May is $15,751. We can take that ending cash balance from May and then move it to our June balance, which is beginning balance, which is $15,751. But in June, our net change in cash is a negative $18,314, which means that if everything remains the same or equal, if you will, we will have a negative cash balance of $2,653. So for planning the budget, we're going to have to try to determine how we can make up. Are we going to borrow some money, or do we have a line of credit that we can borrow against, or do we decide not to pay some of our bills and the amount of that $2,653 to end our cash balance? But those are the options that will have to be answered from our budget. And with that,